It's very pricey. Yeah. We've gone through this. I guess they. I guess there's like Okay, everybody, if you please take your seats. Okay, so in the first category is what's my return? That's what they're thinking about. You have to explain to them how you're going to get them a good return. How is your project going to work? How have you done this before, if you have done this before? What's your plan? What's your scope of work if it's a flip? There's different types of investors, just like there's different types of people. Some people are very analytical, they're going to want to see all the numbers. Some people want to understand the story. What are you doing to help the community? It depends on that. But you have to have all these things prepared to make sure that you can present that piece of information if that's the thing we ask you. Does that make sense?
Yeah.
So the more prepared you are, the better. So you're going to explain to them how you're going to get them a better ROI versus what they're getting. I've had people tell me they're getting 20% of their stock portfolio. Wow, that's incredible. Good for you. Leave that there, right? If that's their reality, stay with it. But possibly maybe diversify out maybe a little bit. So you have to explain to them why your investment's going to be better than theirs. And is it going to save them on taxes? And how might that be possible by your investment? And or the way you're going to structure that investment. And having, I don't know, what's that?
Return on investment.
Yeah. What's the return on investment? Oh yeah, is it per annum or fixed? That's not sensible. Apologies, ladies and gentlemen. So is your return on investment you're advertising or speaking to them about annual? So if they only have the investment for 3 months and it's 12% annual, they're only going to get 3%. Maybe that's okay with them. Maybe that's not okay with them. You have to explain your return because you're going to get asked this question: is it fixed? And you have to be careful with fixed because you might want to give somebody a set return. But depending on what that is, if you extrapolate that over the course of the year, there's a maximum that people can charge for lending. As Constantine could probably, what is the rate? Is it 48?
60.
Oh, yeah.
60 is the actual limit for loan charge?
Well, 60 is criminal rate.
So okay, so anything below 60 is okay.
We charge you below 60.
So 59, up to 59. So you have to be careful. All your interest and fees that you're paying your investor could potentially be against the law and against regulations if you're not careful. So you have to calculate it annually, make sure that it doesn't go over the boundary if you're talking about fixed, because an investor might want to know. They might assume that it's fixed, and you're actually talking about annual. You have to make that very clear because you don't want to get to the signing table or the lawyer comes back and says, wait, no, they point this out to your investor and they go, wait a minute, that's not what we talked about. You have to be very clear about this particular detail. I've had this confusion with investors a couple times in the past. So how are you going to protect their capital? What's the worst case scenario? How are you going to preserve their capital even if things don't go the way you want? Are they going to get a lower return, or is their actual initial investment potentially at risk? They're going to want to know which scenario you're actually laying out with your project. And what happens in the event of a default? Do they have the right to foreclosure? Do they have to sue you personally? Are you personally guaranteeing the investment? Is this only in your corporation's name? There's a lot of mechanics around that. What happens if things go sideways? So what happens in the event of default? What's their recourse? And is that comfortable with that? There's two types of investors I find in the lending space. There's somebody that's willing to lend in a project, maybe a little bit riskier, but there's somebody like myself or somebody else in the room that's a flipper. They might take over that project and they're willing to run with it. They have no problem foreclosing on that property, reclaiming the asset. They're willing to finish the work, whatever the work happens to be in that particular project. But some people aren't. They're passive. They don't ever want to own that house. They're just like the bank, and that would be a nightmare for them. Them having to foreclose and actually own the property, and they're just nightmares of tenants and toilets in their head and all these things. So you have to think about what's the reality for them if things didn't go right, because that does happen. It's an investment, it has risk. So what security are you offering? Are you offering multiple pieces of security? Are you offering it equity in the property? Or is it just a loan agreement? How are they going to be secured? And what does that mean for them if things don't go well? What's loan to value? I'm sure everybody knows loan to value, right? Everybody raise their hands, loan to value, Okay, perfect. So what loan to value is going to be comfortable for them, commensurate to their personal view on risk? And are you going to pay them, are they going to be debt position or equity position? Or are you going to give them both? You might be able to do both in the project. Some equities also, which one's more expensive?
Equity.
Equity is more expensive, absolutely. Constantine's heard me speak before, he knows that. Equity is always more expensive. It amazes me to see those people go on Dragon's Den and give away huge portions of their company, and they end up wildly successful, and they've given away that money forever. And sometimes that's fine. You know, pay, yes,
I
absolutely.
have a question.
Yeah,
I never heard of giving an investor or a partner both things, equity and debt positions.
yeah, we've done it. It depends on the situation, depends on your project. And it can be a small percentage of equity. It doesn't necessarily need to be large. As an example, we're in negotiations for one right now where we're going to get investment of capital. We're going to do a project, and it's going to be a cash flowing asset. And we're going to refinance that capital back out again. And then they're going to be getting a rate, an interest rate on the initial capital for the time we're doing the project until the refinance happens. And then they're going to maintain a piece of equity in the property. So I always like to give people as much compensation as I possibly can. Keeps your investors happy. They want to come back. They're really thrilled about this. So they want to do the next project, the next project. So if you can do both and explain the benefits to them, that sometimes they just want to get paid an interest rate. I'm a simple guy, just pay me my interest rate at the end of the year and I'm happy. That's fine. But if you explain to them, this is a way for you as a project sponsor to be able to get lower cost of borrowing. Does that make sense to everybody? How that happens? Because if you're giving them equity, you can get a lower cost of borrowing for that money to do your project. Who wants a lower cost of borrowing by show of hands? Perfect. So that's one of the ways you can do that, is offer both. And passive versus active. Are they a passive investor versus an active investor? Goes back to that JV. What flavor are they? What style are they? Passive versus active. Am I going to be on title? Do I have to be on title? That's a common question you're going to get asked, because that's going to affect the debt serviceability of that buyer. Opportunity cost comes back into this again. Maybe I can't buy a vacation home in Maui, or I can't buy my next boat because this property's on my credit and the bank's going to tell me no at some point down the road. You have to consider that for your investor if they're going to be on title. And some investors are going to say, no, I want to be on title, it's the way I feel secure, that's what makes me happy, great, and do that for them. But some of them are going to say, well, I don't want you on title, I don't want to be on title, and that could cause challenges if you're going to go to the bank, because the bank wants to know all the players in the game, am I right? So they generally want people to be on title, or at least be a majority shareholder if it's a larger project. So that could cause some challenges. Maybe that's not the right investor for your project if that is a requirement to make the deal fly. And credit risk. So if they are on title, things do go sideways, their credit is at risk. Because if that property goes into foreclosure and they don't have the means to bail it out, then that affects their credit just as much as it does your company's. And in a lot of cases, a lot of these investors, they don't necessarily have corporations. I would suggest that you coach them through the process of creating one, because it's going to lower their tax burden, and that's what we all want. We all want lower taxes, correct?
Yes.
Yes. Okay, perfect. So that's going to be something you should coach them through and show them some options of how they can do that through corporations as opposed to through their personal name. Because passive income, especially if they're a passive person, that passive income gets taxed extremely high. How high?
Very high.
What's the number?
48%.
Yell it out.
48%.
48%. So cash flow is great, but if it gets taxed at 48%, not so great. And there's ways to mitigate that through structure and corporations and coaching people through that. And Alex can help you with that if you need help with that sort of advice. So credit risk and reporting. Now, this is an interesting one. So your investors, it could be a longer project, maybe it's 2 years, maybe it's a year, that's long in a lot of people's eyes. So how often are you going to report back to your investors, tell them how the project's going? Who thinks, how often is a reasonable amount of time?
Quarterly.
Quarterly, great. What else? Depends on the project, depends on the investor. That, you nailed it. It depends on the investor. And it also depends on how you, the project sponsor, set this context in the beginning. How I said, raising the hand, everybody is quiet. You need to do this with investors. And I have made this mistake in the past. It's one of the potholes I fell into, is where a project didn't go quite the way we wanted it to. And it was almost every day. I had to talk to this investor. We are partners for life now. We got through it because I was able to take those phone calls. But if you happen to be working still full time and you can't answer that phone call at 1 in the afternoon when you're in a board meeting, that could be a problem if you didn't set the context to your investors that we're going to report quarterly, we're going to report semi-annually, or whatever the case may be. So that's a really important thing to consider, is how often am I going to let my investors know how well things are going. As you grow and scale your business, you could be dealing with 100 investors potentially on one project. You don't want to talk to 100 investors all at 1 o'clock in the afternoon. Make sense?
Yeah.
Okay, perfect. Cell bill will be astronomical. So this is how the money moves. So a lot of investors are going to ask you, so do I write a check to you? Do I write a check to your company? Do I write to my lawyer? You have to explain that to them. No, don't give me the money. I don't ever want to touch it. You're going to send it to my lawyer. Or you send it to your lawyer, then he'll send it to mine after we sign the paperwork and all these things have been verified and you're comfortable with the terms and you've had independent legal advice. Always make sure that you get your investor to get independent legal advice, because that could cause litigation risk later on if he hasn't had a chance to do that. Because then those contracts may not be enforceable in court. Does that make sense?
Yeah.
Yes.
Perfect.
Then, what was the first one again? What's that say? Default?
Oh, how do you get a higher ROI?
Just below protect capital, the first one, default, is it?
Default. Yeah, what happens in the event of a default?
Oh, okay.
What's the investor's recourse? So how would they come after you for their money, basically, in the worst case scenario? Or how would they have their lawyer? So the second category, so how long is the term? So that's really important to a lot of investors if they want short term. And what is short term, medium term, long term? Class, I want to get some answers.
Months, 2 months, 5 years.
Okay, so what's short term? Raise a hand.
Months.
3 to 4 months. That's, I would consider short term, up to 6. And medium term?
2 years.
2 to 3 years. I would agree with that. What's long term in most people's
10.
common consensus?
5.
10 years. I agree with that. 7 to 10. I would say is a long term project. So, how long is the term for them? That's that opportunity cost we're thinking about. So payments, how often are they going to get paid? How often are there going to be disbursements? Is it going to be cash flow paid monthly, or is it going to be quarterly? Or is it going to be returned at the end of the year because they don't need the cash flow on an actual monthly basis? That's important, going to be important for that. And also, how often am I going to get paid? If something doesn't go right, how much longer could it possibly be? Here's scenario A, here's scenario B if things took a little bit longer than we expected. That's very clear about that up front. Capital gains. This, again, comes back to the taxes. Am I going to have to experience capital gains? If so, how could I mitigate that? How could I be paid differently so that that could lower the capital gain burden to me personally? And is the investment liquid? That's really important for people that come from other types of investments, like the 20% person who's making really good returns in the stock market. Is my investment liquid? Could I cash it out if something happens? What if there's an emergency? Generally speaking, the answer is going to be no in a real estate project. But if it's a larger development, say, project where you're raising money from a lot of people and you have to have an offer memorandum, complicated legal paperwork to be able to do that, is that what you're going to do there is you're going to actually budget in a percentage for emergencies. Because you want to provide good customer service. Somebody has a family emergency and there's a legitimate reason they might need their capital back. You want to be able to give that to them and then raise some extra capital, budget that into your expenses, because I don't ever want to hold somebody's investment hostage if they have a real circumstance in their life. I want to be able to accommodate them as much as possible, but sometimes it won't be. That'll be detailed in the contract that they can't call their investment in most cases. You have to take a look at my project and say, what would happen if my third partner decided they needed to get paid out? Could we do that? Could we sit down as partners and decide that? That's something you have to put in your JV agreement. And so what happens when there needs to be an exit? Or will there be no option for an exit? These are some things you have to consider. And dividends, is that how we're going to get paid out? As far as paid as dividends out of a corporation? Are we shareholders in this corporation? This gets into the creativity of how can we, be the most tax efficient for that particular investor, because their reality is completely different than your company's reality. It might be great to say, I'm going to pay myself dividends, but that might cause a huge tax consequence for them. More of these little things that you think about up front and say, hey, I've considered this, what's the best option for you? Tell me your story. that's what you want to have, that type of dialogue with that investor, so that you can really check all the check marks for them. Because if you get 3 out of 5, maybe you'll get a yes. But if you get 4.5 out of 5, and you're not quite sure about that last one, then you're gonna get a lot more traction with your projects, get yeses a lot more often. So what happens if the term ends and you can't pay them back? Where I was made visible to a circumstance where recently where this happened to an investor on a big way, where the investment company can't pay back their loans. They're paying the interest still, which is great, but they're not able to pay back the principal. So now there's opportunity cost. Now they're looking at, well, hey, wait a minute, I can't go invest in this other thing I want to invest in right now. So what would that look like? How would you handle that? How would you keep in touch with that investor during that potentially tough time where the project isn't going quite the way everyone wanted it to be able to keep them happy, maybe give them a little bit of equity in something else? How would you accommodate them so they stay happy investors? We all want happy investors, yes?
Yes.
Perfect. So what happens if you can't pay it back on time? Would they renegotiate the interest rate, charge you some extra fees? You know, you have to budget for that in your project. That if things take a little bit longer, you've got an option to give them extra compensation. It doesn't, sink your deal. And what happens if you're dead? You're going to get asked that. What happens if you die? Well, the project died with you, right? Which comes down to, do you have a team? Which is critically important in all businesses. You have to have a team, or start building one from the beginning, or have the anticipation to build one. And do you have adequate insurance? So would your insurance cover this? Do you have an estate plan? Do you have a will? All these types of things. If you have insurance, that's great, but if you have no executor, no nothing, it could go to the government, and the government's dealing with the estate, and the investor might be at risk. So what happens when you die, exactly what happens when you die, most joint venture contracts, the bulk of it goes around this. What happens when somebody passes away and can't complete the project? What happens then? Who can step in? Who gets control? How do you deal with the estate? And do you have adequate insurance? And is it managed well in the circumstance if you happen to pass away? And more important than that piece is, do you have a team to execute this? Because really, the estate is going to want the project to be successful and have the maximum amount of dollars come out of it, so that that can go into the estate for the person who passed away. So do you have a team that could run with the project, that you're not a one-man band, and then if you happen to have a life circumstance or you get sick, something else, not just death comes into this, and what happens if you're sick, can't work anymore, will it still get done? That's one of the really important things to consider there.
What if the investor dies?
What if the investor dies?
You still have to pay them back then?
You pay the estate. Yeah, technically yes. Yes.
If you say set up a deal and you said everything will be done and you'll all be paid back in 6 months, but things go extremely well and you finish the project in 4 months, what would happen then? Would you have to pay them like the whole interest for 6 months that you had promised? Or would you say, the project's over, here's your money in 4 months, or how would that work?
That depends how you structure it. So basically you're saying, is it open? Is it a loan in this case, you're asking?
Yeah, if it's, yeah.
Yeah, so that would depend how the loan term sheet would look. So you would say potentially it's a 6-month term with a minimum of 3 months interest, if there's no fees. There's the other component to lending typically where somebody might charge a 10% interest rate annual, and they're going to charge maybe a 2%, 3% fee. So that way that 3% is sort of their minimum return, plus however many months at the annualized interest. So in that case, depends how it's structured. So yeah, I would make that very clear in the beginning. That way the investor knows that if you pay early, what their what the term is and what their ROI is going to be if you happen to pay earlier. And you're going to really kick butt on the project and got it done faster. Which is why typically points are charged in the lending game when people are professional lenders, is because they want to roll that money over. They're hoping you do it in 3 months and they get that money right back out in the field again. Because that's how you make a lot of money as a lender, is through those fees and rolling that money over as many times as you can. And Constantine's smiling because he knows all about this. That it's not really interest rate they're making money on, it's those fees. Just like the banks. The banks make a ton of money on fees. Private lending is very similar in that respect. Answer your question?
Yep.
Excellent. Any other questions on that stuff so far? No? Perfect. So, after we've covered all the things to consider when you talk to them, and there's obviously a few more on the list than that, the next thing is, where do we find them? Where do we find them? So, let's get some ideas. where would we find investors? Of all types of stripes.
Sphere of influence,
Sorry?
sphere of influence.
In your sphere of influence, so your inner circle. Yeah. Where else?
Google.
Where else, ladies and gentlemen?
Real estate seminars.
Email programs.
Okay, how do you get them in the email
Sign-up
program?
lists,
Networking.
networking,
Of course, networking.
yes.
Cash flow.
Other than the cash flow club, yeah. I'm gonna give you some ideas. I want to get some ideas from the class first. Where else?
Advertising.
Advertising. You have to be careful with that though, how you word it.
Dental conferences.
Excellent. Conferences in industry.
Your doctor,
Beg your pardon?
your doctor, your lawyer. Professionals.
Yeah.
Professionals,
Engagement trade shows.
Yeah, sponsor.
trade shows,
That would be like marketing campaigns.
marketing.
Other investors.
Marketing, it depends. I'll say marketing in small amounts, probably not large amounts. Someone is not likely to just call an ad and say, hey, I'm gonna give you 100 grand. That's typically smaller ticket stuff. Where else?
Private business owners.
Private business owners. What else?
Golf clubs.
Sorry?
Golf clubs. Golf clubs.
Oh, golf clubs, yeah.
Or any sport clubs.
Yeah, golf clubs, ski clubs, absolutely. It's a small list, ladies and gentlemen. All right, so my earnest advice to you is group them together for goodness sake. There is three main verticals where you're going to find investors. So the first one is financial interest. Is it interested? Not interest is in return. So financial interest. The second one, if you want to write this down, because I'm not going to go through all these on the chart. The second one is charitable interest. So interested in charity, involved in charity in some form or fashion. And the third one is, you had it before, business owners and professionals. So you have to think where in life, both online and offline, could I find high density of people that could be investors, both passive or active, whatever it is you're looking for. So if somebody is at a stock trading event, so stocks as in invest in stocks, value investing like what Warren Buffett does, stock trading, day trading, foreign exchange, which is trading currency, trying to trade stock options. Who knows what stock options are all about? By show of hands. Okay, just a very few do. So you get the same leverage in stock trading like you do in real estate. So you can buy what's called a contract, and you can control a basket of 100 stocks, and you can trade those options. So you get the same leverage as real estate. To buy an Apple stock is like $580 or whatever it is today. You can control an option on Apple stock for $5, $6, something like that, and it represents 100 stocks. So TD Bank downtown in Calgary actually teaches classes on all this stuff every 2 weeks or so, I believe. And if somebody's interested in trading stocks where they could lose everything if they made a bad trade, there's somebody who's interested in making money. Does that make sense? And if they're willing to take risk that's up here, and you have a project that's risk down here, you can show them how they can maybe diversify some of their portfolio and trade with this amount of capital and invest some of this capital with you, which is safe. Especially while they're learning, they might actually lose a bunch if they're not learning very fast. So, also other things like gold events, how to buy gold, how to broker gold, silver, other commodities, things like that. Colored diamonds and how to buy diamonds and get them at a discount. If somebody's in the mindset of I'm looking for ways to make money, I'm looking for information on how to trade stocks, I'm looking for information on how to invest in real estate or flip houses, whatever the case may be, there's somebody who's interested in building their wealth. Does that make sense? Okay. So anywhere you can find a high density of these people, then you can network with them and show them a different option to complement what they're already doing, what they're already learning. So financial interests. So that's a few of them. There is definitely more of them. Commodity trading, franchise trade shows. There's actually events where people will trade and broker Subways and AWs and McDonald's and things like this. That somebody that has franchises and multiples of them is somebody who's high net worth, as we talked about earlier, because the criteria, I believe last time I checked, to open up an AW is you had to have almost $1 million cash and over $1 million in net worth. So this is somebody who already has resources and access to capital if they're looking to buy an AW or looking to sell it. Does that make sense? So auto auctions, people that are looking to buy antique cars, things of that nature. Also equipment auctions. If somebody, that successful trucking company I mentioned earlier, if they're looking to buy a used cat for their construction company, wherever the case may be, there's somebody who's a successful business owner. And they're there to buy a new cat because they want to expand their business. They're not thinking about real estate. They're not thinking about stock trading. That's where you come in to network with them, get to know them, go for coffee with them and say, hey, how are your investments doing? What do you like to invest in? You're clearly a successful business owner. You know, have you ever heard about real estate or whatever your particular project happens to be? And then the second main category is charity. So if somebody has reached the level of success where they want to get back to their community, want to get back to their church, they want to get back to society in any way, shape, or form, things like art galas. If somebody's looking to buy a $30,000 piece of art, they might just want to buy a $30,000 second mortgage, potentially, if they're at an art auction or something like that. If somebody's looking to donate to a cause that's important to them, then there's somebody who's reached a level of success. They tend to be high net worth people. So look at art galas, events at the museum, things where you're going to have to put on the black tie, the penguin suit, to be able to let in the front door. You might have to pay $250 a plate for some of these events, but you're going to meet a certain level of people that you won't necessarily find at the Starbucks on 4th Avenue, as an example. So fundraisers and networking with fundraising professionals. There are people that go out and raise money for these charities on a daily, weekly, and monthly basis. Sometimes part-time, sometimes full-time. If you network with those people, they also know high net worth people. They have a network of those in their personal sphere of influence, as was talked about earlier. So these people, their objective is to get more money for the charity. So if that high net worth individual makes a high return on their investments, they have more money to give back. So this is a win-win circle for everybody involved in that chain of custody. Stampede parties, corporate stampede parties, where